Hello and welcome to Yadnya Investment Academy. Today we are going to discuss on topic what is a bond. When you purchase a bond, you effectively are lending a company or the government your money. Bond issuer is the borrower. Bond issuer agrees to pay whoever holds the bond interest on a regular basis and then to return the principal on the loan when bond matures. This can make bonds attractive for people looking for a stable investment. Unlike a stock where you are not sure of future cash flows of the company, with bonds you know exactly what they are going to be. Only risk is that issuer ends up defaulting and doesn't pay the debt. The flip side of bonds low risk is that they have less potential than stocks for higher returns. Now, rate of interest a bond must pay depends in part on interest rates prevalent on the date of issue. So, in 2011, if a bond was issued, then interest rates fixed by RBI at that time were very high. So, new bonds issued at that time gave high rate of returns, whereas in 2017, when interest rates are relatively lower, new bonds getting issued are offering very low rate of return. Now, rate of interest is also in part dependent on the credit worthiness of the buyer. That's why central government securities typically carry the lowest yields in the bond market. Large stable corporations such as Tatas, Birlas, etc. pay a slightly higher rate. Bonds from companies with poor credit ratings are known as junk or high yield bonds, and junk bonds pay high interest to compensate for the risk that they will default. Now, another variable key is a bond's maturity date. That's when bond pays back its principal. So, generally, the farther away the maturity date, higher the interest a bond must pay. Except in cases of default, investors know exactly what they can expect to make on a bond so long as they hold it to maturity. But bonds can also be bought or sold on the bond market, which is a secondary market, which means bonds current value, if you decided to sell it, can fluctuate. For example, when interest rates rises, the value of existing bonds in the market will fall. To understand why this is, imagine you hold a 2% bond and now interest rate has risen to 2.5%. Now, with a 2.5% yield now available on the market, no one will buy your paltry 2% bond unless you cut the price. So likewise, a bond price is rise when interest rate fall. So detail of this is in our video how bond market works. Link is here. Now, if you own bonds through a mutual fund, you don't have the option of waiting until the bonds in the portfolio mature. So you own a constantly changing mix of bonds. So the total return of fund is determined partly by the daily value of those bonds in the market. And these funds are mostly called debt funds. Now, since bonds are intended to be sold and bought, all the certificates of bond issue contain a master loan agreement, and this agreement between issuer and investor, called the bond indenture or deed of trust, contains all the information you normally expect to see in any loan agreement, such as amount of loan, face amount or par value or principal amount is the amount of the loan issuer has agreed to repay at the bond's maturity. Bonds are issued with a specified coupon or nominal rate, which is the rate of interest. Interest is paid on most bonds at 6 monthly or annual intervals, usually on either the 15th or 30th of every month. Now, term of bond, the bond's maturity or length of time until the principal is repaid varies greatly and is mostly more than 5 years. Debt that matures in less than a year is a money market instrument such as commercial paper. Now, there is a call feature also. A call feature, if specified, allows the bond issuer to call in the bonds and repay them at a predetermined price before maturity. And if when bond matures, the issuer doesn't have the cash on hand to repay bondholders, it can issue new bonds, and this process is called refunding, and there are details about this too. Now let's see few examples of bonds issued by different companies recently, and here are few examples of short-term bonds and here are few examples of long-term bonds. So generally in the Indian context, you will find the word debenture and bonds being used interchangeably. A debenture is a debt instrument which is not backed by any specific security. Instead, the credit of the company issuing the same is the underlying security. However, bond is issued by large companies, government and PSUs and are mostly backed by some assets. Now we will talk in detail about this comparison in a later video. So if you have any question on bonds, then please do write in the comment section below and do not forget to subscribe to our channel for more such videos. Have a great time ahead.